Traders, good evening. It's Tuesday, August 5th, and I'm thinking it's time for another update. Now, in my two previous videos, I focused exclusively on the Nasdaq 100 using technical analysis to contrast 2014 with 2013. My goal, of course, was to explain why the 2013 playbook wasn't applicable to 2014. I hope I did my job. Tonight, in this video, I'm going to expand my analysis to include other facets of this market, most notably the Philly Semiconductor Index, or SOX. To me, the SOX index is a forward-looking indicator or a leading indicator. It's somewhat of a guiding light. It warns me of impending turning points in the market. Now, before I shed light on the current state of the market, I'd like to take you back to the events of 2011. If you have access to the morning Java 48 report that I published on Tuesday morning, you can scroll down and bring up chart number 2. Do you recall the events that took place in Japan during February 2011? Tsunami, nuclear meltdown, so forth and so on. At the time, the SOX had finally reached the yellow line, this yellow line being the extension of the BD line of this triangle that unfolded from 2004 until late 2007. Now, in February 2011, upon reaching this yellow line, the SOX experienced a trend change. It reversed course heading down into late 2011. However, the major indices, upon selling off in February, resumed higher to set new recovery highs and kept rallying until the end of June, if I recall. On one hand, the SOX was falling, and on the other, the indices, the S&P 500, the Nasdaq, the Dow Jones, all these were rallying and setting one new recovery high after the other. This disparity between the SOX on one hand and the major indices on the other is what precipitated the summer 2011 swoon. Disparities like this, or divergences, if you will, are the sort of thing that you should constantly be on the lookout for in this market. It's the sort of thing that can lead to a major sell-off or even a crash. Now let's fast forward to July, August 2014. In the same report, Morning Java 48, let's bring up chart number 1. Now, the first thing I noticed in my recent examination of this chart is the presence of a contracting triangle in the fourth wave position of this chart. The presence of a fourth wave triangle portends a trend reversal upon completing the final movement in the direction of the trend. So once the triangle is complete, it sets the stage for the final movement in the direction of the trend, which itself should usher in a trend reversal. As you can see here, the first sign of a trend reversal was the head and shoulders. The SOX, by the way, made its stop on July 16th, 1 week ahead of the other indices. And then it proceeded to break down from this head and shoulders, tracing out a 5-wave decline. Whenever you can spot a 5-wave move on the chart, be it a 5-wave rally or a 5-wave decline, like is the case here, you can always bet that upon the conclusion of wave 5, you will get a relief bounce that partially retraces this 5-wave move, and then another 5-wave move will begin in the same direction as the original one. Now, I'm not convinced yet that wave 5 is over. In fact, this chart was captured prior to today's open. And if I'm not mistaken, the SOX actually made a new low today. The ideal target for wave 5 is either the 61.8% extension or the 76.4 extension. It's the area of this open gap. DeMark followers know what the TDST support line is. Now, the fact that a 5-wave is underway tells us what? That upon the completion of wave 5, we're going to get a partial bounce followed by yet another 5-wave decline to either the bottom of the triangle or even below it. Now, why is this so significant? An eye-popping event? For the following reason. If you've been following my Nasdaq analysis, you know that I'm convinced the Nasdaq will soon bottom somewhere near 3,800. And then it's going to resume higher to make a new all-time high. Now imagine this, the Nasdaq making a new all-time high while the SOX making a lower high. Why a lower high? Because I said upon the completion of a 5-wave move, you're going to see a partial bounce and then another 5-wave move down. If that partial bounce coincides with a new all-time high in the Nasdaq 100, as well as maybe the Dow Jones and the S&P, it will create the same sort of disparity that formed during the first half of 2011 preceding the summer 2011 swoon. Now, let me update you on the events of Tuesday, August 5th, as they relate to the Nasdaq 100. As you may well know, the Nasdaq rallied up to the 50% retracement level relative to wave A of Z. And now I believe that wave C of Z is underway. I'd like to draw your attention to the similarities between this pattern here, this rounding top, and this rounding top. This one formed last week, and then we got the breakdown on Thursday. Here we have a similar pattern. Just like we have a head and shoulders right here at the base of the cup, we have a complex head and shoulders here. 2 left shoulders and 2 right shoulders and a head. This formation is destined to be an inverse cup and handle. Now, when you measure the distance from the head to the rim and you project it down, you get a target of 37.88. If you measure the size of wave A and you project it down from the endpoint of wave B, you also get 37.88. Well, that's no mystery. It's not a complex math problem to solve. That is the case because the retracement was 50% and you multiplying it by 2. Therefore, I'm now revising down my final target for the Nasdaq 100 to be 37.88. In what time frame? Look back here. You know that the breakdown occurred on Thursday and ended on Friday. Well, we're right about the same spot. Tomorrow's Wednesday. This could be all over by this Friday. Finally, the S&P 500. I've been tracking the wave progression ever since the start of this decline. I was able to identify the first impulsive down move, red wave A, which unfolded as shown. Black wave 1 followed by black wave 2, a 5-wave move labeled 1 through 5 in yellow, that is black wave 3, and then I got a contracting triangle in the 4th wave position, followed by the final 5th wave to end red wave A. Then I got this B wave move, a relief rally, that set the stage for the start of the next decline or the next wave down, namely red wave C. This began with wave 1 and then a relief rally that tested the underside of this triangle's BD line, and then wave 3 got underway. I believe black wave 3 is still ongoing. As far as I'm concerned, black wave 3 should end somewhere between 1902 and 1893. It should then set the stage for the final relief rally preceding the final move, namely black wave 5, that should end somewhere in the 1870s. Now let me wrap it up with the market profile chart of the S&P 500. I recall in 2013, the S&P sold off from late May until late June. The final low was 1560. And I recall being pretty good at timing that low because it coincided with the yearly point of control. It was perfect. From there, it resumed higher, never to come back to that level again. Now, this is exactly what I believe is happening in 2014. The point of control is the longest row of TPOs in this yearly distribution, and this happens to be at 1873. This certainly agrees with my Elliott wave analysis calling for a final low in the 1870s. Now, if I switch over to the SPY, which most of you trade, and let me set the TPO width to say 25 cents, you will notice that the volume point of control the sweet spot or the price level at which the most business was conducted this year was at 187. So right around 187, say 187.25 or so, we should see the final low from where the S&P or the SPY should resume higher. All right, well, this concludes tonight's video. I hope it was informative, and I look forward to future videos like this one.